Hey everybody, this is Jose Blasco. We are about to start in just 20 seconds. This is a sound check. Please go ahead and confirm with a quick message on the chat box that you hear my voice. That would be appreciated. So I know that we are ready to begin. Thank you so much. 10 seconds to go. Very good, everybody. Very nice, everyone. Thank you for confirming that sound is good. Welcome to the session, everyone. Today is June 18, 2020, Thursday. Welcome to the Get Together session. Today we are getting together to talk about the markets from a little bit of a longer term perspective. So normally what we do is that we use options, isn't it? And we look at opportunities which are directional, opportunities which are non-directional, and whatever the market gives us, we'll take it gladly, okay, as long as it meets our rules. So we'll be doing that today as always. And before we start, I have a disclaimer to read, so I'll do this quickly so we begin. Disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive when using our products. And this is the official disclaimer. So talking about official, the session is officially introduced. So we are now in trading time. Here is the TradeStation platform, ready to begin the day. Quick look at the chat box here, first of all. So we have Lilan. How are you, Lilan? Good to see you. Ruben. How are you, Ruben? Boyan. Sound is good, no video. You mean you have no video, or you? Could you please confirm that video is good now? I think that probably you meant the camera, I'm guessing. Fermo, Jose, how are you? Good, wonderful, nice to see you. Three, the camera, very good. I get you now, Boyan. I'm reading. Royce, how are you? Yes, yes, yes. Paul, Miguel, very nice. Yes, all good, very good. Just checking the all the comments in the chat box. Okay, so it's all good. Everything seems to be under control. So let's begin our day. Okay, so it's 11 a.m. in New York. The market opened an hour and a half ago. I did run, as always, the scans before the market opened. Okay, so all the results of my scans are from before the market opened. There should be valid opportunity, okay? But again, if we're not to find anything that is valid, so what we're gonna do is we're gonna go ahead and rerun the scan, because now after 1 hour and a half, sometimes, not too often really, but sometimes new opportunities arise that were not identified prior to the market opening, given change of market conditions, okay? So we have directional opportunities to go long, directional opportunities to go short. You can see only two stocks show up on the list. Multiple opportunities to be non-directional, even though there is a bunch of ETFs there, and we're going to skip those, isn't it? And then a few opportunities to do neutral long and a few opportunities to do neutral short. So we'll start with non-directional. Okay, we'll start with the non-directional ones. And even before I start, I want to review what we have in our hands since prior sessions. So Microsoft, we have it here. Okay, Microsoft is started making all-time high when that peak was made. Then the market retraced and now is about to begin again making more all-time high. So let me bring in Option Station Pro so we can see the performance of those trades. It's gonna load in just a second. We're gonna move into the Manage tab, and we're gonna be able to see the trades that we have out there. Here we go, Manage. So I'm just clicking the Manage tab. And so you can see here how Microsoft is performing very well. Actually, we have two trades on Microsoft here. So one of the trades is a custom trade for investing long-term, where you can see it's making $41.5. So that one is much more conservative trade, and therefore the performance is less as of now. But then we also have the 195 call. This was a trade that we planned here in the session. That one is performing very well given the push that Microsoft is giving. Okay, so keep that in mind. Should be setting targets, should be trading stops, should be managing the trade accordingly to your trade plan. Okay, the other trade that we have is CVX. CVX is a stock that we enter, in the context of a stock portfolio with multiple stocks, where once some stocks hedge other stocks thanks to positive gamma, and then either positive or negative delta positions. And CVX was a position that we entered short to hedge longs. It's obviously producing a negative P&L, but we are glad to see that this is how a portfolio should look like. Always some positives, always some negatives, and the overall result should be positive. Of course, a proper portfolio, it's more than two positions, okay? But again, we meet from time to time only, so whenever we get filled, that's when we get filled, okay? So, but just keep that in mind. What else do we have? I have a couple more trades here that we planned before. And some of those trades may have been planned in the YouTube channel or may not have been planned in the YouTube channel. Okay, but you also know, probably I'm sure you have seen it on our website, that apart from running a channel on YouTube, we also run another channel on You Can Trade, and you can certainly subscribe and join us there as well. And in that alternative channel, we are conducting sessions every day actually, and we plan this trade on Shopify, where the expectation, we entered the trade that particular day, and the expectation was going to be that Shopify would stay in this range of prices, until tomorrow expiration Friday, June 19. And notice how we are having now a situation where Shopify is breaking that range, okay? And therefore, the trade is in a mode where it could end up failing, okay? Of course, it's an iron condor, and therefore we know the risk is limited anyway, so that's clear. But certainly this is the time where you could enter hedging techniques, you could enter what we have called in past sharpening sessions damage control mode, isn't it? And again, I just wanted to show you that not all trades profit. Of course, some trades will fail, and this is the case of one of a trade which is failing right now. While this is another trade on Abbott, okay, pretty volatile company in most cases, and that one we entered in that particular day, and this one is working very nicely as of now. Is right in the very middle of the range, and one more day, and then we'll have the weekend, and that's a lot of time decay accumulated. Moving towards June 26. Okay, so that's what we have in here, and therefore we are now ready to continue planning trades. Okay, planning trades, and I'm going to start with the non-directional opportunities. I am sorting from more expensive to less expensive those particular stocks. So we have ServiceNow. ServiceNow, if I was to look at the monthly time frame, it's making all times high. If I look at the 55-minute time frame, you can see there are no red UFOs. So we cannot do non-directional on now. So if I move to Biogen, okay, in this case, we do have very strong movements, 5%. We do have UFOs above and probably below if I research enough, okay? But of course, I'm wondering why a 5% jump, okay? Well, maybe what's happening to that stock, I would really not be surprised, is that earnings have just been reported, okay? Oh, actually, they haven't. So that's nice, okay? That's nice. This is making this opportunity to potentially be a better opportunity. So record. I'm just thinking about multiple things at the same time. Doesn't work, isn't it? Earnings are happening on the 28th of July, and today being the 18th of June, that gives us plenty of time to put trades in place. Okay, so certainly a 5% gap down is probably scaring people away and probably creating a great level of premiums on those options. Okay, and therefore, as long as we got everything that we need, we may have an opportunity to do a nice Iron Condor on Biogen. Okay, we'll see if that's going to be the case or not. Okay, so loading Biogen there, 39, 44% volatilities. Let's take a look. Okay, let's take a look. So first of all, we got 52% here. That's good. And second, not sure we have green UFOs there. Okay, so it seems that we're gonna have to load more data. Okay, so here's what I'm gonna do. I'm just gonna disable auto UFOs. I'm gonna move to a daily time frame. It seems that past data that we may need is located there in August last year. So I'm gonna go back to the 15-minute time frame. 55-minute time frame. I'm not sure why I said 15. And I'm going to load first date starting August 2019. Okay, so I'm gonna load all that data, and while the data is being loaded, well, it seems it's already loaded. Okay, great. So I'm gonna turn on auto UFOs now, and I may be able to have some green UFOs below, and I do. Okay, so they are very far away. Okay, they are very far away, but they are there, and they are showing 54% performance. If I look at pre and post market, let's see what we have. We have even more UFOs, but the performance is not good enough. Remember that we have a rule where for non-directional trades we will accept anything above 48%, but 46 is not, above is below. Therefore, we're going to stick to pre and post market data, and therefore those are our UFOs. Okay, that's what we have. So with that in mind, I'm just going to move into the option chain of Biogen. I'm going to pick next week expiration, for example. I don't think it's going to be enough, but let's start here. I'm going to right click and analyze and sell an iron condor. And I'm just going to add 3 price slices. On the one above, we want it to be 1 standard deviation. The one in the middle, we'll use last. And the one below, we will use minus 1 standard deviation. Okay, that's what we're going to do. And again, without even looking at strikes or thinking about anything at all, the only thing I want to make sure for now is that my date is correct. Okay, my date is correct. And while my date is correct, I want to now go ahead and point at the upper part of the statistical range. 1 standard deviation is 284, and the bottom part is 252. Okay, so 284 and 252, where is that in the chart? Okay, that's the big question. So to find out the answer, I'm just going to draw a couple of lines. I also want to differentiate those lines from other lines I'm going to use. So I'm going to make them dotted. So right click and new parallel, and we said one is going to be 252, and the other one was going to be 285. Okay, 285. So if I do that, okay, if I do that, we now understand that based on stats and probabilities, Biogen is likely going to remain between those 2 dotted lines from now until June 26, which is the Friday after. Okay, and not tomorrow, but the Friday after expiration. That's what it suggests. Okay, but what's the problem? Especially when I look at the bottom part, the problem is that for me to be able to plan a trade, I need to rely on at least 2 UFOs. Okay, and if I was to look closely here, 2 UFOs is 1 and 2, so it would be somewhere around here. So I'm gonna have to be selling puts at that particular distance. So if I measure, no matter what statistics suggest, in this case, since the UFOs are so far away, if I was to measure from current price to that purple line below, if I was to measure how far is that, and I was to project the same amount to the upside, okay? So basically, it seems that I would be planning a trade. It's not exactly the midpoint, but kind of, if I was to plan a trade using that UFO above and the UFOs below. So, I would be somewhere in between, and that could be a good non-directional trade. Okay, now this is a humongous range. And because it's so large, my concern, and you may remember, I always have this concern when planning a trade, is how much I'm going to get paid for the calls, especially given the fact that they are so far out. So if I look at the 317 here, okay, 315, we're not going to take that for good. Okay, 48 cents looks actually quite good, but notice the spread from 5 to 90, so we're not going to be able to trade this one. So what if I look at the next one, 2 of July? So if I look at the 2 of July, and we are looking at, what did I just say? 313, so let's call it 315. So again, 120 and 15 cents. Yeah, theoretically it's 68, but it's going to be very difficult to get filled there. Again, probably the same thing is going to happen all the way until I get to 17th of July, because it's a monthly expiration date. It's 29 days to now, from now. Okay, so if I look at 10th of July, I'm just going to look just in case, but probably I'm going to have the same type of problem with the lack of liquidity. Yeah, 145 to 40. So it's not really liquid enough. Okay, so my last attempt, and if that one doesn't work from a liquidity point of view, so then that would be it, is to use the monthly. Okay, and the monthly should be better, but not sure how much better. Well, it's still quite, wild. Okay, it's quite wild, because 140 to 310. If you think about it, the 220 is more expensive than what you could sell the 315 for. Which again represents a great level of lack of liquidity. Okay, but at the same time, while I'm saying this, I do see hundreds of contracts there in the open interest. Okay, so given the fact that this is the monthly expiration date, we may have a little bit more attraction, and it's going to be unlikely for us to get filled. But if we put the order in, who knows? There may be someone willing to take it. Maybe some market maker with very few trades on Biogen that may need to undo some trades or do some hedges or whatever, and they may want to take the other side. So the only chance we got with that stock, given the liquidity levels that we saw, is to use the monthly expiration date, which is July 17. So what's the problem with that? Well, the problem with that is that if you think about the analysis tab, we calculated the standard deviation to be plus and minus, and it became 252, 285. So the question is, if I switch this to 17th of July, of course, the range is going to widen majorly. The question is, are those UFO now going to be far enough or not? So let's take a look. If I move to 17, okay, and again, since I got error messages, just should be fine even with the error messages, but just to make sure I got no problem. So I'm going to redo it here using July 17. So Iron Condor, okay, and here we go. So it says here that the range would go all the way to 301 and 237. Okay, so 301 I believe is fine because we got 313. 237, to be honest, I don't remember. So let's take a look. Oh yeah, it does work. Okay, so if we were to move this to 237, okay, and that one to 237. Okay, this is interesting, guys. I got the very same problem the other day. The very same problem the other day. This is interesting, isn't it? Okay, great, interesting. So I'm just having, just for you to know, I'm just having a weird issue with my keyboard and mouse, which is normally not a device that tends to produce issues, but in this case, it is producing issues. So I'm gonna have to go ahead and be a bit aggressive here. Okay, so I'm just gonna go ahead and kill my virtual machine and start again. Okay, so sorry for that. I'll just be back in 1 sec here. That's gonna be pretty quick, as you will see. And then we'll continue with the planning of the trade. In any case, while I'm rebooting, good news, it is certainly looking like that we're going to be able to do it. Okay, we're going to be able to do it. So, I mean, we're going to be able to plan the trade. That's what I meant to say. Different story would be to go ahead and be filled on the trade, because my concern, as I mentioned, is the liquidity. So we may be able to build a trade, but we may not be able to get filled at the price at which we want. Okay, so anyway, doing a couple of things in parallel here to get TradeStation restarted and everything working as it should. Okay, so one sec. Okay, so just re-inputting. Here we go. So TradeStation is back to be reloading. And I am back to restoring everything that has to do with my beautiful pointer device that got us this little problem. So I believe I should be fine until the end of the session. No, I don't think I'm gonna be fine with this keyboard. So I'm just gonna get rid of this keyboard for the session and use another keyboard. Got multiple keyboards on my machine, and that will do. Okay, so just bear with me on that, if that's okay. And you may see me turning a little bit more to the left than usual, right on your on from your end, but I guess it's fine. Okay, so I'm gonna load BIB again, muscle memory, using the wrong keyboard. Just looking at your messages. Pansy, how are you, Pansy? Gary, how are you? Good to see you guys. Good to see you. Good. Okay, so almost there. Okay, so now I need to get my Option Station Pro. We're really close now. Okay. I may need to reload more data here. We loaded data all the way to August 2019. So first date, August, and then it's gonna be 2019. Here we go. And again, as I was saying earlier, my concern with this trade here really is the fact that the liquidity is not good. So we may have a beautiful trade in the theory world, and then some of you may get filled, some of you may not get filled, depending on how demanding you are with price, the time of the day at which your order is in, the broker, and the efficiency of the routing. This is something that could happen. Okay, so we'll be looking into that after we are done with putting the trade together. Okay, so again, using we concluded before the little reset I had to do, we concluded that using options located all the way up there around 313 and using options all the way below around 217, that's the way to do it. Okay, that's the way to do it because the statistical range, if you recall, BIB, so we have to redo the whole thing, isn't it? So 17th of July, right click, analyze and sell an iron condor. Okay, so if we were to do that, and I need to add one price slice, and we need to make it -1 standard deviation. So when we did all of that, we concluded the range should be 300 over 236, okay, something like that. And certainly, if 236 is somewhere here, okay, we can totally see that 217 is beyond 236, as well as we can see that 213.99 is also beyond 300. So in other words, we do have a range which is wide enough. The options, when we looked at the option chain, seem to pay enough. Like if we sell the 315, in the theory world, we're at 210. Again, with that spread, it's not going to be like that, okay? But we may get a fair value, and certainly more than 35 cents, which is what our rules suggest we need when we do options trades, isn't it? So in that sense, on the upper part, we're going to be getting ready. Let me shrink this a little bit. So we are going to get ready to do the call side on the top, buying and selling a call. The one we selected was going to be 315. I need to look at which one we're gonna buy above. Okay. We are using, remember, July 17, 2020 expiration. Okay, and then in the bottom part, okay, I need to look at which one, but we need to sell a put and then buy a put below. Okay, that's the plan. Okay, in case you have not seen this before or you are attending the session for the first time, the minus sign means selling the option. The plus sign means buying the option. The C, of course, is for the calls, and the P for sure is for the puts. Okay, so around 217, what do we have? Okay, and when looking at the chain, we got 220, we got 215, and yeah, this is really problematic here. Okay, well, we got zero for the bid, so no one is willing to buy those options. This is really problematic, guys. This is really problematic, guys. It was looking good from the call side, but the put side is looking terrible, even though normally it's the opposite. The call side is the one that looks the weakest. In this case, given the fact that the call side is a bit closer to the current price and the put side is a bit further away from the current price, so liquidity is worse with the puts, and therefore, while we almost got there, I'm gonna say this trade does not qualify. Given what we need from a trade. So we are gonna pass on this one, okay? So let's go for the next one, okay? So we said no to Biogen after the whole thing. So we're gonna look at UNP, okay? And while UNP is loading, I would like to look at UNP earning dates, okay? And with UNP, we are dealing with July 16. So same story. We got like a month in front of us that allow us to use the next Friday and the next Friday and the next Friday. So all of this is nice. We can also see that we have UFOs above and below. We can also see that we have more than 48%. Actually, if I move to pre and post market, how much would that be? It's 38%, so that's not good. But certainly, if we stick with regular session data, certainly we got something powerful enough to plan a non-directional trade. Okay, so we're gonna work on UNP and see where we go with that. Okay, I'd like to get a bit of feedback from you guys. Not that we got deep into any trade yet, but just to know that you guys are good and everything is going well. It'd be good that you just type a quick okay or good or any positive word. And if you want me to repeat anything or you have any question, you can certainly type that too. Okay. How are you, Thomas? Good to see you. So anyway, so let's go for it. So we got UNP. Okay, UNP. Remember, we can use expirations all the way to July 16, but we like to start with shorter expiration dates. So I'm going to look at next Friday, and without even thinking about it, I'm just going to right click to analyze and sell an iron condor. So that way I can get my statistical measurements. I'm going to change minus 5% for plus one standard deviation, and the plus 5%, I'll change it for a minus standard deviation. And this is telling us that given the implied volatility built in the options on that particular stock, the price movement is expected to be based on the pricing model to go all the way to 181 and 161. Okay, so 181, 161, that's the expected range. So just like I've done before, I'm gonna plot a couple of dotted lines. Okay, a couple of dotted lines, so 1 and 2. Okay, and basically we said 181 and 161, I believe I said, right? So 181 and 161. 181, 161. So yeah, my lines are not totally precise, but I would say that's good enough. So now, with this in mind, okay, we need two UFOs above and two UFOs above and two UFOs below. So if I look below, I got 1 and 2 already. Okay, so the next one is going to be the next one, which is the first one beyond the range. Okay, that's going to be where my extreme is located at. And on the upper side, I got 1. Okay, and the second one is right there. Okay, now I am tempted to move it a bit higher, and here's why. Let me measure it so that way I'm going to have a very specific and clear reason instead of just an impression. So no subjectivity, guys, no subjectivity. When in doubt, just go ahead and measure things so that way you can have thorough decisions without the subjectivity. So this is the distance from the current price to the bottom part. So if I project this to the upper part, actually I did not look at this correctly. Actually, it's perfect. Okay, it's perfect. So if we were to use 182 and 159, the current price of that stock happens to be exactly in the middle part of the range. Okay, so this is exactly, this is kind of like the perfect world of an iron condor. Maybe I should have made this bigger from the beginning. So this is kind of like the perfect world of an iron condor. Okay, and you are exactly in the middle. Okay, now before we get too excited, let's take a look at how much we get paid for the call side using 26. We got the 182.5. Okay, and even though we got 35, which is the minimum we will want to accept, and that's fine, but I'm not happy, guys. I'm not happy because we got 001. So if I try to sell that option, it's going to be so difficult to get filled. No one is buying those options. We do have a few hundreds of the contracts there, but really nothing significant. And then when we move into the other strike, you can see the open interest is 6, which is very, very low. So this is basically not a very good news because it kind of forces me to go check July 2nd to see if liquidity is better there. Okay, and if I look at this, it is indeed better. Okay, it is indeed better, and it's still not amazing, but it is indeed better. Okay, so let's go ahead and take a look at what will happen if we do July 2nd for expiration. That's gonna impact. So be ready to see a change here on this one. Okay, this one there. Okay, and also that. Oh, sorry for that, guys. This one here. Okay, so these two values are about to be quite different the moment I change the date from 26th of June to 2nd of July. So watch that. 1, 2, 3. Here we go. Okay, so now it becomes 184 and 158. Okay, 184 and 158, and that means that 184 now is somewhere here, okay? And therefore, I need to use this as my extreme, which is the end of that particular flying saucer, that UFO. And if I was to look at, was it 152? 158, sorry for that. So 158, so 158 is somewhere here, which means that now I will need to move in here, okay? So let's do the same thing, okay? If I measure the distance from here to here, now is more distance because we got more time to expiration. So that's fine. But if I project this to the top, look at that. Perfect. We are as well, in that sense, very well located, very, very well located in the very middle part of the range. That's nice. But again, the concern is always the same. How much I get paid for the 186 now? Okay. And by the way, probably it's going to be the 185 because there is no 186. Okay. So how much I get paid? Okay. Well, you will get paid 54. Okay. Which 54, it's certainly more than 35, which is our rule. And then this is a trade that could be accepted from that point of view. Liquidity is not the best in the world, but certainly it's not like the next one where you can see 4 and 50 something. Okay, so that's very problematic. And by the way, that's going to hurt us as well, because even though the one we sell is the 185 and this is the one that will produce the greatest amount of profit for us. The reality is that we need to buy an option against the option we sell, and then we're going to suffer the slippage on the next one. So that may force us to go for the next one, and therefore increase the risk of the trade from $2.50 to $5. So we will see that. Okay, I'm just anticipating things that may happen, but just for all of this to be clearly understood, I'm just gonna type it on the chart, and then we will do the analysis. Okay. Iron condors in general, non-directional trades, these are opportunities that are fantastic, but they also imply some, fine-tuning time. Okay, so you need to give yourself your time to go through the setups, and many times, liquidity is not good. Okay, I need to discard. Okay, it's part of trading. But the moment you get a yes, okay, those are trades that normally work quite nicely. Okay, so it's worth it to put that particular time in place. Okay, at least in my mind, or at least in my way of on how to look at the markets. So we said on the top we're gonna be selling the 185. That's what we said. Okay, and we have seen 185. That's what I meant, and we have seen that we also have the 187.5, even though it was lacking liquidity. So let's see. And then in the bottom part, it seems that 155 is gonna be the one. Okay, 155 is going to be the one for the put, right below 155.78. So let's go ahead and look at how much we get paid for the 155. And the 155 again, lacking some liquidity, but again, the midpoint 1 point something is certainly way more than 35 we need. So we can go ahead and give it a try. Okay, so and we also have the 152.5, which is $2.50 away. We also have the 150, which is $5 away. So really, we do have a balanced setup from a strike selection point of view, but we need to have all of this analyzed to see if we can accept it or not. Okay, now to be visual again, from top to bottom, we buy the 187.5, we sell the 185, and on the bottom we sell the 155 and we buy the 152.5. On the top is calls, on the bottom is puts. Good, so let's go ahead and analyze it. Okay, so we said on the call side we are buying 187.5, selling 185. On the bottom part, we said we are buying the 152.5 and selling the 155. Okay, that's what we have, and that's what seems to be available. Okay, so let's do a bit of analysis here. Okay, let's do a little bit of typing. So first of all, let's focus on the units that we have here in the middle, the ones that we sell. Okay, those are the, sorry for that. I'll do that again. So we are focusing on the units in the middle, which are the ones that we sell, the 155 and the 185. And we already saw earlier that we have a minimum requirement for these options, where the premium to be collected for both of them have to be at least 37. Let me rephrase that, $35. So, and we saw that's the case. Okay, we saw that's the case. So we are good with the premium collected. Okay, but then we have another rule that states that when doing these sort of trades, okay, we want to make sure that the risk the trades imply uh, is based on the vertical distance, which is based on the vertical distance between the two strikes. 152 and a half, 155 is $2 and a half. Okay, same for 185 and 187.5. So in both cases, either the call side or the put side provides $2.5 of distance between strikes, and therefore $250 of risk. Of course, the real risk is $250 minus the premium collected. The premium collected, you can see it here. Okay, right here you can see it. So if we were to collect, okay, exactly the midpoint, okay, which is $67, the risk of the trade would be 250 minus $67. Okay, that would be the risk of the trade. But again, for us to assess the trade when it comes to understanding if the trade is to be accepted or not, we don't really care. We don't really care about what is the real risk of the trade. We only care about the distance between strikes. Okay, those are the rules that we have. In this sense, the distance between strikes is 2.5. And the rule that we use, okay, to accept or discard the trade, we take 2.5, okay, and then we multiply this value times 15%, which is 0.15. And that is 37.5 cents, okay? And as long as this is paid to us, then we accept taking this trade. And obviously, notice how now it's pointing at 44 dollars of premium to be collected. Notice earlier, a minute ago, it was 67. So what is that telling you? This is telling you the liquidity is quite terrible. Now it's 55, 56. So again, good news and bad news. I got one of each for you guys. So the good news is that we do have theoretical premium enough to take the trade. So the trade is validated. This is a valid trade to be executed. So I'm going to place the order in. Bad news, okay? Bad news. This trade maybe one of those trades where you place the order and at the end of the day you didn't get filled because you are asking too much premium, and given the lack of liquidity, you may not get filled. So if that was to be the case, so be it, because certainly for the trade to be valid, we do need to collect enough premium. So what you never want to do is to go market. Okay, if you go market, you're gonna get killed. Actually, you're gonna have to pay $40 for the condor instead of get paid $56 for the condor. That's how wide the spread is. But again, since we're approaching this trade in a way where you can just put it in there and just wait until the expiration, you don't need to exit, even though certainly you could use some hedging techniques or damage control techniques, converting the condor into a butterfly or other techniques to manage this trade if the market was to move against you, like in the case of Shopify. So you can certainly do that, but it's not like you're gonna stop yourself out with a market order, someday because the market moved against you, and then you're gonna use a stop market order. You would get completely killed on slippage if you were to do that. Okay, just like the trade I showed you earlier with Shopify that was moving against us. If you were to get out of those trades with a stop market order, you will really, really regret that action, because the slippage, you're gonna take the whole slippage. Market makers are going to be laughing at that action. Okay, so we just cannot do that. Okay, so in this case, the challenge is we may not get filled. In this change, the beauty is that if we get filled, the lack of liquidity does not matter any longer. So therefore, this trade is valid. Okay, so let me re-explain the whole trade on the screen. Okay, we are basically about to enter the trade now. The expiration date that we are using is July 2nd, which is right there, okay? And therefore, basically, this trade, okay, is an opportunity where the expectation is that the stock will remain between the vertical and the horizontal lines from now until that July 2nd. So that's the plan for the trade. We got UFOs above and below to defend ourselves. So really, to be honest, the setup looks nice. Okay. The only problem is liquidity. We may get filled, we may not get filled. So I'm just gonna go ahead and place the order. Okay. So place the order trade. Again, when looking at the liquidity right now, the midpoint is 49. A minute ago was 50. We even saw 56. Keeps moving up and down. Now it's 57. So again, certainly we don't want to go market. Let me show you. This is what not to do. Okay, careful everybody. This is what not to do. So go market means that you would get 34 positive. Okay, instead of a credit of 48, you would have to pay a debit of $34 to get into the condor, which is complete nonsense because then you are guaranteed a loss of that amount, and if it goes away from the range, even more. So we do want to make sure that you use a limit order here. And given the fluctuations we've seen up to 60. So I'm just gonna go ahead and say, you look at that right now we're just 60. I'm just gonna go ahead and say, what about we go for 50? It would seem fair to me. 37.5 would justify the trade. So let's just do 50. And of course, I'm going to use a day order. So if I don't get filled, I can always reevaluate this tomorrow. Okay. So this is how I'm going to place the order. Place order 1, 2, 3. Okay. Yes. Okay, and now it's confirming the whole thing for me. You sure you wanna do the condor with those 4 units, blah 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 blah, and the answer is yes. 1, 2, 3. That's it. So the order is in. I have it here in the manage tab. Iron condor waiting to get filled on UNP. It's a day order, so if I don't get filled before the end of the day, then it will the order itself will go away. Okay. But if I do get filled, then I will get my 50 cents. So I would suggest that you approach it from this angle. And by the way, didn't say it, but if you were to approach it from this angle, then this is a trade with exactly $200 of risk per contract, because each contract carries $250 of risk given the distance between strikes, but then you're going to get paid 50 to do the trade. So really, per contract, your net risk is $200. Okay, so that's the trade we just came up with, which is now in the market. Okay, good. So let me take a look at the chat box in case there is any question. I can see good. I'm great. Good so far. All good, Jose. Wonderful. Love to see that. Okay, just to get a bit more interaction, if that's okay. Any question concerning this trade? If no questions, just please type no questions, so I know. And also, are you putting this trade in the system? I'd like to know that. And I'm not certainly suggesting that you have to do that. I'm just saying that if you are executing this trade, and that applies to simulated accounts as well. Okay, so if you're going to be executing this trade, I would like to know, so that way I know your thinking or feeling towards this trade, and that would be very useful for me as your coach. Okay, very good. So if that's okay, I'm going to have a sip before we go for the next trade. Thank you very much. I needed that. Waiting for a fill. Very good. Okay, and you guys are gonna have to be patient, okay? Because liquidity it's weak. I get you, Ruben. Fancy the questions. Trying to get it filled at 50. Very good. Absolutely understood. Good one. Love the teamwork. Thanks for that, guys. So let's continue. Let's go into another trade. Hopefully, we can find another non-directional trade since we are here and doing non-directional. It's 11:42 in New York. The session is supposed to end at 45. So in theory, we got 3 minutes. I'll extend a bit more than that. But since we are in the world of non-directional, so let's continue. Hopefully, I can find a setup. And of course, now I'm gonna move quickly here. I took my time to explain everything in the first trade example. So this time I will be more efficient with the use of the time. So that way, hopefully we have time for another trade. Hopefully we'll find another trade. So pending data for Honeywell, we got 46% here. So that really doesn't make me happy. What if we look at pre-post market? 44%. So we're going to discard Honeywell. There is not enough institutional interest. IWM is an ETF, IEF is an ETF, FISV. Let's take a look at this one. So we're going to have to wait until it loads. In the meantime, checking earnings report. That would be happening on August 4. So that's very nice. That gives us plenty of time with FISV. 55% probability. This is also nice to see. Do we have good probabilities with pre-post market? Let's check. 43%, that's not good enough. So we're gonna go for the regular session, okay? And I'm gonna make this a bit smaller. And we do have a collection of UFOs above and below. So yeah, all of this is looking good. Initially, you would think that we should be able to put together a trade here. My only thought in the back of my mind as I'm loading the option chain is gonna be liquidity. FISV is not the most liquid stock in the world. So let's take a look and let's see what happens, okay? And one day to expiration that we're just gonna pass. Notice another clue that tells us that that stock is not gonna be too liquid. We don't have weekly expiration, only monthlies. So we now know it's not gonna be the most liquid stock in the world, but also we know the monthlies are normally more liquid. So maybe it's doable, it's workable. And you know what? It's not so bad. 384, 190 to 10. So depending on how far our strikes are gonna be, this is gonna work or not. Problem also is that we got $5 strike price increment. So we'll see. So let's go ahead and let's do this. Right click, analyze and sell, iron condor. Okay, let's do it. Let's add one slice, minus one standard deviation, plus one standard deviation. This is telling us 115.92. So when looking at the chart, 115 is there. So we can use that one here, 117. So let's take a look at the 117 and see the premiums there and how it's going to be. Okay, and we're going to have a yes or a no very quickly here. And it's going to be a no, okay, because 120 is providing 28 cents, is less than 35, and liquidity is getting very bad. Now I'm gonna have to sell the 120 and buy the 125, and notice now I got 0 and 60. So I'm, really not in a good position there. So again, kind of expected. So what about Abbott? Well, with Abbott we have one already, so we'll leave that one alone for now. What about Merck? Okay, so with Merck, while Merck is loading, MRK. Okay, so what's going on with Merck? Earnings happening on the 31st of July. So all good for a non-directional trade. Pending data, so data is being downloaded. First look, 48%, we're good. And then when it comes to pre-post market, what do we have? 1, 2, 3, come on. We got 52%, which is better. So I would prefer to work on this one. So let's give it a try for Merck. Okay, and also as I'm loading all of these, more thoughts to share with you guys. Let's say you are in the trade with Abbott and it's a non-directional one. Question, please answer on the chat box. Should you get into another non-directional trade with Merck? Should you, if you already have a non-directional trade on Abbott? What would you say to that question? You guys let me know. In the meantime, I'm gonna add an iron condor here. So right click, analyze and sell. Iron condor. Okay, so plus one standard deviation, minus one standard deviation. I'm going to read your answers in a sec. And we got 79 and 72. So when looking at the chart, 79 is somewhere there. And 72 is there, so I can use this. Okay. Now, if I use, well, actually, I cannot use that one because it's only one UFO. Okay, I cannot use that one. It's only one UFO. Let's take a look at the regular session, I should say. It's the same UFO. Okay, so on the top, I also have this one. So I have multiple UFOs, and the next one on the top is here. Okay, and those are still valid too because they are 48%. So that's fine, but not on the bottom. Okay, so on the bottom I got this one and I got that one. So I will need to use 67, or let's look at pre-post market. Well, really, it would probably make sense to be thinking, yeah, it's still 67, but that one there, okay? So yeah, we just cannot use 71. That's for sure. And now, if I was to project to be equal distance with the top, so if this is gonna be our reference point, which is the current price, and I was to project this, I did this backwards, guys. I don't want to extend right. I don't want to extend left. I'm really not sure what's going on there. Okay, so I guess I got it. So from the current price, which is my reference, to the bottom, this is the distance. If I project it to the top, okay, then I think that you are with me that using that UFO would be the way to do it, to be more or less centered in the range. And certainly, we have more than two UFOs above, and we do have two UFOs below, which is our minimum requirement. Okay, so this could be a valid range. So now the question is 84. How much we get paid for the 84? Okay, so 84. How much we get paid? 2 cents, 7 cents. So that's not good enough. With 26, what if we use July 2nd, the 84 something, pay us? Let me load the whole thing. I will load the whole set of options available. So 84, 85 is paying 8. That's not good enough. What about the 10th of July? So the 10th of July, we got 84, that's 16, not good enough. This is the last one I want to check. The monthly, 29 days, how much I get paid. I get paid 21, that's not good enough. So we don't get enough premium. Okay, so Merck, even though it's showing up on the scanner, it is unfortunately not providing enough premium to justify our trade. Remember, we have a requirement of 35 cents. Okay, so with that said, guys, we got a no in the next trade that we were planning, and therefore the trade for the day is the trade on Biogen, isn't it? That's the one. Let me write it down. So I'll keep it here. So BIIB, so we can review that. Okay, so here's the one. Oh, it was not Biogen. Can you believe it? I just forgot the symbol. Okay, so let me. It's so many trades, so many markets, and every day different executions, and then when I do the session, sometimes I get all mixed up in my brain. Yeah, I remember we said no Biogen. Okay, so let me see your answer as well as I'm loading this to the question concerning Merck. Yeah, that was UNP, exactly. That was the one. So UNP, that's the one. Okay, so we'll save that. Anyway, let me see. Paul, new to options, just taking it all in. Very good. Perfect. That's the way to do it. Okay. A very good colleague of mine likes to say you learn through osmosis. Okay, so he may be listening to this, by the way, or maybe Leland, you can let him know. I am going big, Leland. Price is 52. Very nice. Again, you may or you may not get filled. Same for the 50. Okay, it's it's gonna be it's gonna be 50% probabilities. I would say it's either a yes or a no. We'll see. Ruben, if they are correlated, then better not. Exactly. Because then if one of those stocks breaks the range, probably the other one is going to behave, as well aggressively, traveling fast in one direction or the other one, and therefore you may have your two non-directional trades not working well. Okay, so you want to create some level of diversification, even though the stock market is a stock market, but at least separate sectors. It's certainly something healthy. Yeah. Furman, you're mixed up all the time. Got it. Well, it feels good to know it's not only me. That's a good one. Anyway, guys, as always, super pleasure to be in the session here with you guys. Hopefully the session was helpful to you. Watch it again if it was a bit too fast. Again, during trading times, I do like to be efficient with the time. During sharpening over the weekends, when we do sharpening, I take it easy. So make sure you are well in tune with in sync with the calendar in our webpage, and when there is a sharpening session on the weekend, you come see us. You come with questions so we can talk about the specifics about what is it that you need. And if you cannot show up that day because you happen to be busy, not a problem. Just send an email with your questions, and then we'll give answers to those questions in the session, and then you can watch the recording. So it's all good, my friends. Pleasure. Take care. See you soon. Be safe. Follow the rules. It's all about discipline, my friends. Bye bye.